Röko AB, a potential post-IPO sleeper. Röko was a hot stock when it came to market in 2025. With a CEO who had skin in the game and deep experience from Lifco, many investors were excited to see where this could lead. If the company could sustain a high reinvestment rate and strong returns on capital, it had the potential to become a long-term compounder. No wonder expectations were high. As with many IPO stocks, ROKO came to market at a rich valuation. Cornerstone investors had a long-term view, and many were eager to own a so-called compounder. Under such conditions, an overpriced IPO was almost inevitable. Despite only being founded in 2019, ROKO traded at a share price of 2,800 SEK shortly after IPO, corresponding to a market cap above 30 billion Swedish kronor. This implied roughly 40 times free cash flow. That seemed elevated given the company's short operating history and growth numbers. However, the valuation could be justified, at least in theory, by investors' belief in the terminal value of the firm. The core assumption was that ROKO could reinvest cash flows at high returns for a very long time. I have previously discussed how investors and serial acquirers often appear to be valuation insensitive, to put it mildly. If a large portion of a company's perceived value lies in the terminal value, there is almost no upper limit to how expensive a stock can appear on today's metrics. One can always defend multiples above 40 times cash flow, more than 10 times sales, or over 100 times earnings. If an analyst slightly increases terminal growth in a discounted cash flow model, or lowers the discount rate from 9% to 7%, the valuation can be pushed higher quarter after quarter. As we know, price targets often chase stock prices, not the other way around. The fact remains that even compounders need to be bought at reasonable valuations. You cannot simply assume a high reinvestment rate and strong returns on capital and hope that the market will continuously agree. Eventually, expectations need to be met by results. When ROKO traded at 40 times free cash flow, it had a valuation similar to Lifco. This is not a random comparison. ROKO CEO Fredrik Karlsson was the long-serving CEO of Lifco from 1998 to 2019, and many investors point to his track record as evidence that he can replicate the same success at ROKO. However, it's not that simple. ROKO has adopted a sector-agnostic approach, which many investors see as a positive. The argument is that the growth runway is larger if every company in every sector is a potential acquisition target. Some also argue that this allows for better capital allocation by comparing opportunities across industries. I understand these arguments, but I do not agree. Being completely sector agnostic is not necessarily an advantage. In M&A processes, you often compete against buyers with deep industry-specific knowledge. A sector may have benefited from a decade-long tailwind, making recent performance appear non-cyclical, when in reality, tougher years may lay ahead. Remember, there might be someone just as smart or even smarter on the other side of the table, and the sellers want a decent price for their company as well. Compare this to Lifco. They have a corporate culture built over decades. As a student of corporate history, I know how difficult it is to change corporate culture. This is why I believe Berkshire Hathaway will continue compounding even after Buffett, and why I believe Constellation Software will continue without Mark Leonard. Likewise, I believe Lifco will perform well even without Karlsson. If we truly believe that these CEOs are exceptional, then we must also believe that they have built cultures and incentive systems that will outlast them. I'm not saying this to diminish Karlsson's achievements, quite the opposite. What he accomplished at Lifco was extremely difficult, but that also makes it difficult to replicate in a brand new company. Strong past performance does not automatically translate to success in a new context. Lifco operates with a very specific model and deep expertise in medical equipment and services. The Bergman and Beving family follows a similarly focused approach, emphasizing capital employed and aggressively shrinking underperforming businesses. Constellation Software and VTech Software invests in niche vertical market software providers. Imagine if Constellation suddenly started investing across every sector. That would be a major red flag. Even as Constellation has grown larger and explored bigger acquisitions, spin-offs like Topicus and Lumine, and adjusted incentive structures, they have done so very cautiously. The company is extremely reluctant to move beyond its circle of competence. Compare this to ROKO's sector-agnostic approach. I'm not saying that ROKO's strategy cannot work. Over time, they may develop their own culture and model, but this is rarely achieved without making mistakes along the way. Company is only around 7 years old. We do not yet have a long financial history showing organic growth, returns on invested capital, or an understanding of how cyclical some of the underlying businesses might be. At this stage, it is difficult to draw firm conclusions. Any confidence largely rests on trust in management. I understand why many investors feel that way, but it is important to emphasize and recognize that a track record at Lifco does not automatically translate to success at ROKO, especially when the acquisition model is materially different. I need to see much longer operating history and more financial data before considering an investment. If one assumes a 15% return on invested capital and a 100% reinvestment rate, then yes, ROKO would be a great investment, even if current cash flows appear low relative to the market cap. But assumptions are not results. What have we seen since the IPO? Weak profitability and poor organic growth. Management itself has expressed dissatisfaction with the numbers. Perhaps some subsidiary managers struggle with being part of a small unit within a larger public company. Perhaps key subsidiary CEOs are proving difficult to replace. Perhaps some businesses are more cyclical than first anticipated. These are issues that are hard to forecast in advance. This is precisely why a longer track record is necessary before assessing business quality. The proof must be in the numbers, not only in a CEO's past achievements. ROKO simply has too short a history to conclude, with high confidence, that it can compound capital at attractive rates for decades. Many investors will point to management and say that they trust them. In my view, that is too simplistic. Even with strong management, young companies like ROKO will inevitably face unforeseen obstacles. The businesses ROKO owns will not magically start growing faster organically, regardless of how capable the CEO may be. And acquiring companies across Europe using a sector-agnostic approach is inherently difficult. ROKO may very well turn out to be a great investment, but I need several or more quarters of consistent evidence before I can make an informed assessment. The current cash flows alone cannot justify today's market capitalization. Despite falling more than 40% since the top, the current valuation at 24 times free cash flows embeds a lot of assumptions about the future. One must have a strong conviction in high returns on incremental invested capital, a high reinvestment rate, and a long runway for growth. At this point, I simply do not have enough confidence in those assumptions to justify an investment. Thanks for listening.